Hi, this is Dr. John Grazel, and this video is a supplementary video on the issue of microfinance in development. Now, first of all, what is microfinance? Generally, microfinance are small loans. The U.S. government at one point defined them as loans of $500 or less, but that's somewhat arbitrary. They could be $50 loans, they could be $200 loans, but they're generally capped. $500 has tended to be the large cap. So that microfinance are small loans. They're also a development phenomenon, as exemplified for the fact that Muhammad Yunus, who created the Grameen Bank and is very often called the bankers to the poor, won the Nobel Prize for economics. Now, all over, when you talk about development, microfinance just comes into the picture and into everybody's mind as an obvious approach. What else about it? There's been an explosion or in the types of microfinance, however. They're just not little loans. You have microfinance to NGOs, microfinance for individuals to individuals. You have gigantic banks in Indonesia that now serve to provide microfinance. So there, you have on the web places you can give money for microfinance. So it's an expanding phenomenon. And there's no question microfinance is something that has proven to be very useful in many cases. It wouldn't have continued to the extent it has if it wasn't. But what do we have to know to really understand microfinance? Well, first of all, one should know is that credit has been around probably since the beginning of the agricultural revolution and probably before it. There are traditional needs that have always been answered by traditional credit. And the examples are suddenly need medicine or needs for something like a marriage. And there have always been mechanisms. There have been people who've been called money lenders and who provided money for those special needs. And they still exist, actually. But we have now is modern needs. Now, the difference between a traditional need and a modern need, the traditional needs tended to be part of the life cycle. Modern needs are part of the market economy. We live in a market economy, and we live in an economy that is capitalistic. That means you need capital in order to procure goods, services, and rights. And the need of capital is the modern need for credit. Now, traditional lenders have very often gotten the bad name, sometimes deserved, sometimes not. People said, well, they've actually charged exorbitant rates. They enslave people basically by putting them in debt for life. True in many cases, but not true in other cases. In many other cases, one learned that actually traditional lenders were lending to very small markets and actually in very easy transactional form. So you can't just write a blank stereotype in terms of traditional lending. But what traditional lending didn't do is provide that type of working capital that was with a clearly defined reasonable interest rate that was highly available in terms of for particular transactions, such as buying seeds for a farm, opening a business to buy capital, and such. And that's where microloans have come in. In modern credit system, you don't have money gouging, but you have an increase in risk, and when you can't pay back, people go broke and very often actually lose the goods that they have. So there are pros and cons of both. And how did it start, microfinance? And if we understand how it starts, might we be better able to actually use it in the future? Well, first of all, it's very clear to begin that what microfinance actually started in many ways through studies about savings, people's problems, poor people's problems. And one of the things that was discovered about poor people is that they had a savings problem. In fact, people tried to save for emergencies, for medical, for somebody not being able to work. But they had nowhere to save. You save it under the mattress. You save it behind a picture. The termites literally eat it. And so a lot of the initial work, and a lot of this was done particularly by a group out of Ohio State, realized that the problem was savings mobilizations. And in fact, just as there is traditional credit, there's traditional savings mobilization. How did that happen? I'll give you one example. In various parts of Africa, groups would get together, like 12 women. Every month they each give each other, they put $10 into the pot, and every month one of them takes the whole pot. So that gets $120. That's the de facto saving $120 a year. So there were traditional savings institutions, but the idea comes if you can make them modern, people can have safe places to put their money, and then you can actually use the money to lend to other members of the savings associations. And so you began to mobilize people. And it was a group phenomenon where you would mobilize a group of people who had a sense of common purpose, and they would actually vouch for each other. So that instead of having capital and collateral for a loan, you had a vouching on the part of others. They tended almost always to be women, because women tended to be much more collaborative and open to this. And they were accompanied very soon with extended help on the actual use of that money. And that's where the Grameen model differed from some other models. Some models just gave money. Grameen said, along with the money, we give assistance to see that the business works, and we also give assistance for other things that affect people's lives. Literacy, health, things that make you better able to function as an economic person. Now, that's been great. What's happened since then? Well, if you look at that formula I just described, what it really comes down to is that microfinance as a success was very much initially built on what I call social and spiritual and not just economic basis. It was groups of like-minded people who had a sense of commonality and actually a sense of group responsibility that actually were keys to its successes. And it was group unity, the fact that they worked as a group, took savings mobilization as a group, vouched for each other as a group, received benefits as a group, and they actually helped each other. You had social and spiritual commonality, you had group unity, and you had a sense of mutual aid of each other as being a key to success. Now, what has happened since? More and more the focus was on the money and not on those other elements I just described. And people began to think that it was the money that was the key need and problem that microfinance solved. In looking at that, they also went from the unity of groups to individuals. Oh, it's people, poor people, who need money. And in the process of trying to expand it, they went from a model that was service intensive to one that was more business oriented, approaching microfinance almost as a form of business banking. Now, good, bad. Well, it has been a tremendous success. The Grameen Bank was a success. Indonesia was a tremendous success. It's expanded. There actually now are, within countries and internationally, coalition of microfinance groups which help not only promote it, but actually help change policies within nations that allow greater mobilization under the laws of banking and such. But it has also become a silver bullet. People automatically think, oh, the solution is microfinance. Just give them some money. And when it becomes a silver bullet, it then begins to betray those three key initial elements that so contributed to its success. And where some people actually think it can easily be done by just getting on a computer and saying, oh, I give $500 to Mrs. Y or Mr. X. So what's the lesson we're trying to learn? Microfinance has been a fabulous example of development success, but one, it's beginning to have problems because people have forgotten it is a means to an end, not an end in itself. It was put in as part of an investment opportunity. It wasn't just, oh, you have a credit card and you get money you need. It was tied to an investment opportunity. It was used as a point of unity for relationships around mutual aid. And last but not least, it was seen as a step to a better future, not as a ceiling. You gave microcredit to get people, particularly women, empowered, mobilized to change their lives, and then to go further. It was not a ceiling where you say, oh, poor people are poor, but now we'll give poor people access to credit.